Hi everybody, welcome to our webinar, How to Improve Your Trade Selection Using Direction and Pattern. As always, we need to remind you trading futures and Forex are risky endeavors and not suitable for all investors. In addition, the techniques I demonstrate are proprietary and should not be retaught or retransmitted for any reason. My name is Jay Norris. I'm a 20-year trading floor veteran of the Chicago Board of Trade. I've also written a couple of books on trading which were published by McGraw-Hill. The tactic we're going to show you today is highlighted on this book on the right, Mastering Trade Selection and Management. What makes these books unique is that they both include trading plans which allow you to backtest the information provided. I'm big on methodology, so before we get started, a few words on method. You must have a robust trading method which works in all environments if you're going to trade successfully. It took us over 4 years to put together a trading course that teaches an empirical, objective method that you can use in all trading environments, meaning in up markets, down markets, sideways markets, regardless of shifting fundamental conditions, regardless of the day-to-day news flow, i.e. bull market, bear market, you're going to be prepared for it. It's so important that you have that method ahead of time because without it, you really don't stand a chance. And the one thing the method should provide for you is peace of mind, because you're going to have peace of mind that your method is effective if you're going to be in this business for any amount of time. I'm very proud of our method because it combines two very important aspects. Number one, the mechanical studies that we rely on. I think it's important that you have both mechanical studies and behavioral aspects to your method. Our mechanical studies are how we determine whether a market's in a bull stage or a bear stage. Pretty simple determination to make. So we're always going to use a mechanical aspect that's objective. It's black and white. It's really based on math, whether the pattern is bullish or bearish. So we're always going to use the mechanical studies to determine if a market's bullish or bearish, and also to determine if we're going to be a buyer or a seller in that market. So we're always using mechanical studies. It's very black and white, which market to trade, which way to trade it from. And then the behavioral aspects, that's going to cover influences such as economic releases, also behavioral component layering out of a position against structure, support or resistance, also using momentum to our advantage. That'd be another behavioral determinant in trade management. So we're very big on combining the both of them. I think you need both mechanical studies and behavioral aspects in your trading plan. I don't think you'll get that all-important comfort level in trading without combining both mechanical and behavioral aspects to your trading plan. Something else, a method must most definitely be simple, at least easily explained. Whatever method you're using or whomever is teaching you the method needs to be able to explain what studies the method is based on and why the method works, and you need to be able to do that in as few sentences as possible. I'll give you an example. Here's our longer-term method in one sentence. We focus on markets with low non-systemic risk, i.e. currency markets, stock indices, exchange-traded funds. They all have low non-systemic risk. Ideally, you're not going to have to worry one day that you can come in and the market you'll trade will be down 50% or something like that. So currencies, stock indices tend to be definitely more towards non-systemic risk, definitely lend themselves more to non-systemic risk. And we look to trade at those times when the day-to-day news flow is aligned with the primary or secondary pattern. That day-to-day news flow is very important to us, as are those longer-term time frames. I'll give you an example of a market where we have this alignment most recently. Here's the euro US dollar, and you can see that secondary pattern has been up all along, really since September, October it's been up, and that day-to-day pattern up also. When that day-to-day pattern shifted back up in here, that was a very important moment for the euro because it really keyed us in on buying this dip right there. And you see that purple line where the dip was? That's just a 50% retracement. So 50% retracement in a market where the secondary pattern and the day-to-day pattern are up. It was really no surprise that we saw this leg up here, this rally. And if you follow our weekly updates and our midweek Forex forecasts, you'll see we were anticipating that rally and that we're pretty much outright bullish on this market, for the last couple of months or so. And that's why, because we knew we had the day-to-day was aligned with the secondary pattern. And that's a powerful combination to have, especially have a little bit of momentum behind the move like that, as you see that MACD gave you. And no surprise that we saw higher prices. So again, we're always looking to trade when that day-to-day is aligned with that secondary or that primary pattern. We also teach shorter-term trading. Here's our shorter-term trading plan. We could say we can focus on markets with low non-systemic risk, once again currencies, stock indices, and look to trade at those times when the micro patterns are aligned with the day-to-day news flow. We define the day-to-day news flow as the day-to-day pattern, anywhere from 2.5 weeks to 2.5 months. I always say show me a month's worth of data on a 4-hour chart. I'll show you that day-to-day pattern, that day-to-day news flow. It's generally going to pop out at you if you have a month's worth of data. And it's also a reflection of the day-to-day news flow. So it's both the day-to-day pattern and it's a reflection of the day-to-day news flow. Here's an example of trading on those micro patterns when they're aligned with the day-to-day flow. Here's dollar-yen most recently, end of December, when we're recording this, and you can see our day-to-day pattern was up, the day-to-day's up, and all these lines represent micro patterns, and they all happen to be that same ratio also. See that rally and then the retracement, and then the rally, then the retracement, and then we take the overall move, the rally, and then the retracement, and you can see it's stopping at that familiar zone. We actually call these risk tolerance threshold levels. They're very important to us. A simpler term would be a buy zone. So you can see it got right on the bottom of that buy zone here. Here it settled on the top of the buy zone, gave a nice double bottom there. Similar, you had a nice formation here on the zone also. So these are examples of trading when the day-to-day is in line with the micro pattern. So this is a bullish micro pattern here. All these are actually bullish micro patterns, and they're in line with that day-to-day. We're going to give you a little bit more detail on this particular trade setup and actually signal momentarily. So don't get bored. Stay with us. Now I'm going to cover something I don't really cover a lot with our own students. You'll never hear us talking at Trading University about anything that's not successful. We're not here to show you what doesn't work. We really need to focus on showing you what does work. But I think it's apropos that given most of you are not students of ours right now, that we cover that, and perhaps you can learn something, and ideally we can get you on a better track. So the question is, why do most retail traders not succeed? Well, we think, number one, they have a preconceived idea of what a market will do, which is supported by what they see and read. That'll get you in trouble. The problem with preconceived notions is that by the time you find out you're wrong, it's generally too late. So we teach our students right away how to get past that. Another big reason is they don't have a sound understanding of risk. It's very important that you understand risk. You have to understand that every position holder in a market has a price point at which they will capitulate and exit that trade at a loss. And it's usually less than people think either. Usually they will exit a trade quicker than they think. In fact, it's for the most part going to be an unconscious decision. This is because losing feels worse than winning feels good. When you're in a trade, it literally comes down to fight or flight, and most people are going to exit the trade at the first sign of pain and generally exit that trade at the exact wrong point on the price chart. We actually call that point a risk tolerance threshold level, and that's something we cover extensively in our courses. So you have to understand risk. You have to understand your own risk tolerance price point also. And this is a big reason people don't understand the importance of using market-generated setups and signals. The market itself has to be the one that's going to tell you whether you're going to be a buyer or a seller. The market has to tell you what the majority of patterns are. If the majority of patterns are bullish, then that market is bullish, right? So if the majority of patterns are bullish in a particular market and you have a retracement and it comes back down and gives you a double bottom on a 50% level, such as we saw in that other chart earlier, and we see quite often in markets, then that's the market supplying the setup for you. It's not you determining that that's the time to buy. It's the market itself. So always let the market tell you what to do. Ideally, you're looking to buy dips on support in an overall uptrend, and you're looking to sell rallies against resistance in an overall downtrend, and it's going to be the market that determines everything along the way. Whether it's in an uptrend or a downtrend, the market's already going to have that determined for you. The market will provide those resistance levels also, as well as the timing for the signals when it comes down to it. So understand that it's not your job to figure all this out. You're going to let the market do that for you. So how can we help to improve your trade selection? The most important thing I learned over the course of the 4 years creating our course is know when direction is aligned with price pattern. It's critically important for us. Before we could do that, though, you may need to know the definition of direction. It's very important that we know how to determine direction in a market. Direction's a funny thing. It's actually what we call a change of direction, and it's going to equal a trend line break plus a directional line shift. That's right. Direction for us is the same as change of direction, because if I'm going to tell you the direction's bullish, that's all well and good, but I need to also go back and show you exactly when that direction changed from bearish to bullish. And I need to be able to go back as far back in time as you want and show you all those changes, show you what defines a change of direction, because it's not really direction we're interested in. We're interested in change of direction. We need to know what the direction is, and we need to know when that changes. So we define a change of direction as a trend line break plus a directional line shift. Some of you may not know what a directional line is. We covered it in that second book, Mastering Trade Selection Management. Let's define it for you. And if you're not familiar with this term, if you haven't read our second book or you're not a student of ours, you may want to write this down. Directional line is defined as the low of the highest closing candle in an uptrend or the high of the lowest closing candle in a downtrend. There's only one directional line per time frame. It's going to shift back and forth from being bullish to bearish. Okay? It's always the low of the highest closing candle in an uptrend and the high of the lowest closing candle in a downtrend. Go ahead, write that down. Remember, it's not the highest candle, it's the highest closing candle. It's not the lowest candle, it's the lowest closing candle. That level is going to be significant, and we'll demonstrate that for you. Very simple, the directional line is used is if price is closing below the directional line, direction is down. If price is closing above the directional line, direction is up. Let's give you a quick example, and then we'll go to the chart and demonstrate it. Remember I said the low of the highest closing candle in an uptrend? Here's an uptrend, and here happens to be the highest closing candle in that uptrend, right? So we mark the low of the highest closing candle. And we mark the trend line also. So when price closes below both the low of the highest closing candle and the trend line right here, that's a change of direction. That's a bearish change of direction. That equals a reversal. Likewise, we come down to here. That's the lowest closing candle, right? Not the lowest candle, the lowest closing candle. Mark the high of that lowest closing candle. Once you close above both that high and that trend line, you have a bullish change of direction. So very important that you understand a price reversal equals a trend line shift plus a directional line shift. And hopefully you wrote down the definition of that directional line shift. Now let's go to a chart and we'll show you how we use that effectively in the markets. Remember we said the highest closing candle, right? You always want to mark the low of the highest closing candle. Here if I go back on this Euro chart, I go back to February, and that's the highest closing candle on the chart, isn't it? So I'd mark that low. The low of the highest closing candle is going to be significant to me. So when you close below the low of the highest closing candle, then we had a change of direction, right? So price did change direction right here. But what's really not that significant for us about this change of direction is the pattern itself is bullish, right? You have a higher high, you have higher lows also. So we're really not interested in a bearish change of direction when we have a bullish pattern. We need a bearish change of direction with a bearish pattern. Now here's another change of direction right here. This marks the highest closing candle of the move here, right? This is a new move. That's a new uptrend. So there's your new highest closing candle, okay? that high closing candle, we're going to mark the low of that highest closing candle right there. So when you close below the low of the highest closing candle and you close below that trend line, let's draw a trend line there for you, and you close below that, the low of the highest closing candle, that's a change of direction right there. Well, are we interested in that? Well, you know, it's kind of iffy. You still have a pattern of higher lows essentially, right? This is still a higher low to that. And you're not quite sure if you have, you know, yes, you do have a lower high here, but it's kind of iffy. I'll give that to you. So I'm not going to hold against you if you pass on that change of direction because we're not quite sure if the pattern is shifting or has shifted. Now, here's an example of, here's the highest closing candle right there, right? I'm going to mark the low of the highest closing candle right there. Mark that low of the highest closing candle and the trend line also. Here is definitely going to be a change of direction that I'm interested in because you definitely have a pattern of a lower high, a lower high. That's the second lower high. So you have a second lower high, meaning you have a bearish pattern. You have a bearish change of direction in line with the bearish pattern. That's definitely a signal you're going to be interested in, a sell signal, right? Now, down here, here's another one. Here's definitely another change of direction. Well, here, let me show you a bullish change of direction. Here's the lowest closing candle, right? At the time, that's my lowest closing candle right here. So when you close above the high of the lowest closing candle, let me mark that high. Let me spread it out. There we go. That's the high of the lowest closing candle. So when you close above that and a trend line, let's put the trend line on there. Technically, you have a bullish change of direction, don't you? So right there, you have a bullish change of direction. You close above the trend line and above the high of the lowest closing candle. Are we interested in that as a buy signal? No, because if you look at the pattern, you have one of lower lows still, okay? Lower low, lower low, lower high. So that's a bearish pattern. You're not interested in a bullish change of direction in a bearish pattern. You may be interested in using that to exit a trade and to avoid sitting through a counter trend trade, but you're not interested in a bullish change of direction here. Now, what about right here? This looks like this is my highest closing candle right there. Let me just move that line down. So I'm marking the low of the highest closing candle in this uptrend, right? So once you close below both that low of the highest closing candle and my trend line here, bear with me, you close below both of those, bearish change of direction in a bearish pattern, that's one we're interested in, right? If you get short there, you put a stop above the highs, even though it comes back against you. You have a short-term shift here. If that stop is where it should be, you're going to stay with that trade and you're going to ride it down. It was a pretty good one. Now, what about this change of direction right here? You had a little bit of a correction right there. We'll put the trend line on there. There's the trend line. Looks like that's my lowest closing candle right there. See that? I'll move that line over. That's the lowest closing candle in that correction. Now here's a change of direction we'd be interested in. Why? Because the pattern's bullish. This is a higher low. This is a higher low. So you have higher lows. You actually have higher highs too. Here's a higher high to that. Here's a second higher high. So you have a second higher high and you're forming a second higher low. So when you get that bullish change of direction right there, you're interested in that because it's in line with the pattern. We wouldn't be interested in this bullish change direction here because the pattern is still bearish. We need a couple of higher highs and a higher low to shift that pattern. So we're interested in bearish change of directions when the pattern is bearish. We're interested in bullish change of directions when the pattern's bullish. So pretty simple stuff. The key is going to be always taking that change of direction signal when it's in line with that predominant pattern. We hope this little demonstration helped you. If you want to know more about what's going on with us, you can check out our website, Trading University. You can click on the Education tab and you can sign up for any of our demos there. You can click on Market Commentary and you'll see plenty of videos. You can see many of our forecasts. You can go back 6 months to a year and see how we did on some of those forecasts. If you're interested, you want to know a little bit more about who we are and what we offer, We're pretty unique in the industry. It's a 6-month program. It's only 20 pips per month. It's $199 per month. You pay as you go. Here's what's unique. You get access to everything up front. You get access to core concepts, advanced concepts, graduate course, master's course, which is taught in live markets by myself, and it's archived. You get access to everything up front in your first month. Everything's online. You come on our campus. All the videos are on demand. So for 20 pips a month, yet first month, $199, you get access to everything. Now, that's not to say you're going to learn everything in the first month. However, by having access to it, we encourage you to go through there and review it and make sure that what we're teaching is for you. Okay? So if you don't like it, you're definitely not going to continue to pay the 20 pips a month or the $199 a month, right? So along with the 6 months tuition, access to the live courses, the archives, you also get access to one-on-one mentoring and office hours. You have access to our Skype chat group with instructors and other students. I'm in there quite a bit during the London session. You'll also receive a copy of our coming risk tolerance threshold theory. We're getting great feedback on that. We just sent copies out to our clients. They're finding that very helpful. And you'll also receive market alerts that utilize the methods taught in Trading University using those risk tolerance thresholds. If you want to know more about us, come see us on our site. Hey, thank you very much, and we hope you found something useful in today's demonstration.